Hello, everyone. Welcome to the Lago Vista High School Money Matters podcast. I'm your host, Coach Castle, along with our financial guru, Mr. Coach Sauer. Welcome back, everyone. I'm glad you're tuning in for the second episode of the Money Matters podcast. We'd like to welcome Coach Sauer back again, the man, the myth, the legend. Coach Sauer, how are you doing today?
Doing well, Coach. Thank you for having me. I appreciate it. Honored to be here.
It is a pleasure as always. When I get to see your shining face, it makes my day better.
And shining head.
Looks good today. I assume that your makeup artist and everything powdered you up before you came on camera.
I did start showering again recently.
Welcome back, everybody. Good to have you here. Want to give a couple of shouts out. Okay. We have some high performers in the Money Matters section, and we always like to give out some congratulations. Bella Drybroke, great job of doing your assignments today. This is Monday. What are we on here? April 6th. Okay. Great job. Sophia Zwerb, Jillian Childs, Jason Sanders, and Sadie Castle, great job doing your quizzes. It's much appreciated. Again, as we are going through this situation, you understand that you are going to have to do schoolwork online. All right. Coach Sauer has some worldly advice about doing this sort of technological ventures in your life. Coach Sauer?
I was just commenting, I've said this to a few people, that this is a great practice for our young people to become adults, because you're only accountable to your effort and what you really want to do. And this is being an adult. You can choose to go to work or not go to work. You'll pay the repercussions, but go ahead and choose to do the right thing.
Well said. Well said. That is good advice. All right, so we're going to be talking about loans and amortization of loans. And basically what that is how you are going to pay back an installment loan, okay? So it's not always going to be equal parts principal, which is the amount you borrowed, and interest, which is the fee that you're paying to borrow that money. Okay, this usually occurs in your mortgages, which are home loans, and your auto loans. They're going to be the same amount every month, but it is broken up differently between what goes toward your principal and what goes toward your interest. I'm going to get on Canvas here on the screen and then kind of show y'all how to get to that assignment. We'll watch that short video, and then me and Coach Sauer will explain a little bit about how those loans work. All right, here we go. Here is your module. Again, it's going to be in the optional enrichment and review module. Okay. And we will be doing loan payments. This is number 4. I labeled these basically, 1, 2, 3, 4, 5, 6, 7, however many we go to, just so you know in what order to do them, when they came in. You'll do them in the order in which they're listed. All right, so we'd go into loan payment. Answer questions 1 through 3. I'll let you read the remainder of the directions, but we're going to focus on the vocabulary terms. That's principal. Okay, that's the amount of money you borrow. All right. It's not the person who runs the school. Okay, when you're talking about borrowing money, the principal is the original amount borrowed. So if I borrow $100 from Coach Sauer, the principal is $100. The loan term, that is the length of the loan. So if I tell Coach Sauer I'll pay him back in 1 year, the loan term is 1 year. Interest rate, that is the fee that you're going to pay to borrow the money. And that'll be usually given to you in a percentage. Okay, so if I borrow $100 from Coach Sauer for a year and he charges 5% interest, at the end of that year, I'm going to pay him $105. Okay, the interest rate is a percentage, and that is the fee. The interest is the fee that you are going to pay for borrowing money. All right, so the link to the video is here. I'm going to click on that link, and we'll watch the video here together and then go over the material covered in the video. And action.
Improvement, it's important to know how your loan payments work.
Yeah, if you've got a loan, don't understand how that loan gets paid off, you might mishandle your payments and risk hurting your credit. Financial expert Kathy Stepp is here. All right, how does a typical loan payment work?
Well, good question. I mean, I think people have their loan payment books, but they don't really know how it works, and they really need to understand. The way it works is most loans are amortized, which means they're calculated so that you have a regular monthly payment over some fixed period of months so that at the end it's paid off.
Okay.
So what are you trying to pay off? You're trying to pay off what you borrowed. The cost of paying that off or getting that loan is the interest. So with each payment, you'll be paying some interest and some principal toward paying off what you borrowed. So here's an example. $20,000, say it's a car loan for 5% over 5 years. So your payment is $377 per month. You need to understand that the way that works then is with each payment, you're first paying the interest calculated on the outstanding balance or the amount you still owe. You're going to pay that first. But you always pay more than that, and that extra part that you pay is the amount going to principal. So that on the next payment, the amount that you're paying to interest goes down. So in that car loan example, the first payment, you're paying $83 to interest and the rest to principal, but by the last payment, you're only paying $1 of interest and the rest to principal. So with each payment, you pay interest on what you still owe first and the rest to principal. The reason you need to understand this is if you decide to make extra payments, it just goes to principal because you paid your interest first.
Okay.
So here's just another example. If you decide in the middle of this loan, this is say payment number 10, you make an extra principal payment, so you're paying $500 instead of $377, you're still paying the same amount of interest on that payment because the amount you still owe is the same, but the rest is going to principal. So instead of paying $300 to principal, you're paying over $400 to principal. So what does that do for you? It pays the loan off earlier. Your next payment, less goes to interest, more goes to principal, gets paid off earlier.
There are some provisions where you can pay it off early, and that's a good thing.
Excuse me. Absolutely. If you pay it off earlier, you're paying less interest, which is the cost of the loan. Provisions, yes, but there may be a penalty.
Yeah.
So you want to check on that. Usually that's not the case, but there could be a prepayment penalty.
Sorry, it's hot in here. I was needing a coffee.
Sorry, we had to watch the
I
end.
cool down by
that was a
9
funny,
o'clock
awkward part.
Hey, if you have a question.
All right, so again, that can be a little confusing to understand. I pulled up a little chart here, okay? Usually you can look these up. This is bankrate.com, I believe. You can put in a loan amount, the term of the loan, and the interest rate, and it'll basically give you an amortization schedule about how much you're paying each month toward interest and how much you're paying each month toward principal. So, and it's kind of cool to understand how this works because, and I certainly thought as when I was younger, if I bought a $200,000 house and I paid $100,000, you know, in monthly mortgages and monthly payments, you know, after I paid off $100,000, that I would only owe $100,000, or roughly in somewhere in that area. Obviously, a little interest, but it's funny to figure out that, you know, especially on a 30-year mortgage, the majority of your payments for the first 15 years are going toward principal, excuse me. So this is just an example. If, you know, you had a mortgage for $200,000 and it's a 30-year term, which is your average term for a home loan. Okay. And let's just say the interest rate was 4.5%. There's your monthly payment. Okay. $1,013.37. You're going to pay a total interest of $164,813, which means for that $200,000 house over 30 years, you're going to pay $364,000. Okay. And this is kind of how it actually prints out a schedule for you on bankrate.com. Okay. So May 2020, we make our first payment. Okay. We made the payment for $1,013.37. Okay. $263 went toward principal and $750 went toward interest. Again, I'm rounding. Okay. And let's say we kept making payments over and over and over and over and over and over and over for several years. This column right here is amount paid total. Okay. So once we've paid our $100,000 roughly, okay, we still owe $146,000 on the house. Okay. So you understand that as we go, all right, we're paying more principal and less interest. It works inversely, all right, which I have a kindergarten explanation here, but it certainly works for me. I got to get Coach Sauer's face out of the way. But let's say you owe you pay $100 each month on a loan. Let's say the principal is 50 and the interest is 50. Okay, and then from there on out, your principal is going to keep getting higher. You're going to be paying your principal down more, and you're going to be paying less interest. Would you agree with that, Coach Sauer?
I would. And what's interesting, if you could do, Coach Castle, you scroll down to where you were December of 2032. So I think we would all assume that not when someone buys a house for a 30-year note, doesn't mean they're going to live in that house for 30 years. They may get a new job. They may want to move. Something may happen. And let's say we lived in this house for 12 years. You can see that we've paid $100,000. We have $146,000 remaining. I'm looking at that, I think is what it says there. At 12 years, but we got to remember, we bought the house for $200,000, and most time, 12 years, that house is going to what we call appreciate. So chances are I'll be able to sell the house for maybe $300,000. I'll be able to make some money back. I'm not going to lose money on that. That's an important distinction when we think about that compared to financing a car. If we finance a car and we keep a car for 3 years and we decide to sell it, chances are it's actually dropped in value as opposed to raised in value. And we still owe money on it, which means we have to pay the bank money in order to sell our car. A lot of kids forget about that, and that's an important distinction between where you borrow and where you don't.
Man, what an awesome, he pretty much put investing in a nutshell. Again, you're borrowing money for this home, but it's an investment. That's just an awesome point. And like he said, automobiles are not a good investment unless they're a classic or something like that. That's an excellent point, Coach Sauer. Okay, so what we're going to do is I'm going to go back to Canvas. Okay, again, I'm going to try to get it to where it semi looks like what y'all have on there. All right, so that was number 4. It's not an assignment. It's just basically where you can get your information. And then we're going to move what your assignment should be. You should have already done this, but if you have not, all right, we're going to go to the quiz. All right, this is an open quiz. Again, I deleted it at one point, so I apologize about that. I already knew that Jillian and Sophia and Jason and Sadie had already taken this, so don't worry about it. You don't have to take it again. That just basically goes over what you're going to need to know in this quiz, okay? And we'll go over the answers here now. So, right here, number 1, when loan payments are amortized, the total amount you owe every month, all right, for the most part, is always going to stay the same, okay? Stay the same. Again, it's a fixed payment. The only thing that varies is how much interest you pay, how much principal you pay, okay? Question number 2, if you have an amortized loan, what does the amount of interest you pay, or excuse me, why does the amount of interest you pay decrease every month? The answers are the interest rate decreases over time. The interest rate doesn't decrease, okay? Unless you have a variable loan, okay, your interest rate will stay the same. It's going to stay the same throughout the term of the loan. All right, the correct answer is the principal is lower each month. You're always charging that percentage rate off of the remaining principal. And if you're paying off the principal, you'll be paying less, okay, toward interest. And then so it kind of works inversely. All right, as the principal, as the payments go on, you're going to be paying more principal, less interest. Okay, so that is boom. With an amortized loan, what happens to the monthly principal payment over time? Okay, I've already clicked the correct answer. It's the principal paid each month increases over the term of the loan. All right, as you go throughout the loan, you're going to put a higher percentage towards principal each month. Okay, the percentage of your monthly payment. All right, question 4, when talking about borrowing money, all right, what does the interest rate mean? Okay, we talked about this earlier. The interest rate is the amount or the fee that you are going to pay for borrowing that money, and it is usually given to you in a percentage rate. And right here, all right, it says The correct answer is, this is the fee you pay to borrow the money. It is a percentage, example, 6.5% APR. That's annual percentage rate. That's what you're going to pay yearly. Okay, APR stands for annual percentage rate. And number 5, what does the loan term mean? All right, loan term is the amount of time you have to pay the loan back, usually expressed in months, or this is the fee you pay to borrow the money. Okay, we knew that was interest, trying to trick you there. The correct answer is the amount of time. Just like a president serves a 4-year term, okay, term is just a length of time when used in this context. Coach Sauer, you have anything else to add?
Yes, sir. I think that when, as young people, we often think that we're probably going to grow up and be wealthy because that's probably what we want to do. And so that becomes something that we think is going to happen. It very well may. I have a question for you, Coach Castle, as someone that has been a pro athlete, and we think of people that are in, movies or in athletics and get paid to play a sport. How many people, or what experience do you have of seeing people that didn't understand these concepts, and even though they're making a ton of money, maybe see them fall or fall short, or run into some shortfalls or some areas of concern?
Did you say, have I seen people, or?
Yes. Have you seen?
I'm going to say, in my line of work, my previous line of work, I mean, it's probably 50-50. I mean, the lack of financial knowledge for young people is astounding. And I was actually one of those. I mean, I thought I knew a lot about money, and I grew up in a family that had parents who were around and were successful, but I still never really grasped how money works. And again, you may make a lot of money. That doesn't mean you're going to be wealthy. Okay. I always give a perfect example is, you see all these athletes going completely broke. You're talking about making millions of dollars and be completely broke. And then you have my in-laws, you have Sandra and Billy King. Okay, they've worked basically, your ordinary blue collar jobs, and they were super disciplined over a long period of time. And now they're retired. They have a travel trailer. They get to go on vacations when they want to, because they could control their spending behavior. And number one, they also made savings a priority. I think that's the big issue in today's world is we don't make saving one of your top priorities. And the earlier you start, the more successful you'll be, in my opinion. But that's a great question. Just because you're rich doesn't mean you'll stay rich.
Yeah. And I would almost rather bet on the person that makes less money and is disciplined about saving it than the person that makes a lot of money. Now, if the person that makes a lot of money is disciplined about saving it, then they actually have a double bonus, right? Then they're even that much more ahead of the game. But unfortunately, I think the stat that I saw is people in the NFL with their average career being like 2.5 years are typically out of money within 5.
I can certainly believe that. Well, and what's cool about money, or just real success in general, I think when you take whatever money you have, whether it's $1 million a year or whether it's $20,000 a year, and you control that money and you are disciplined with it, and you make that money do what you want it to do and be disciplined in your savings approach, I mean, success is success. You feel that intrinsic reward of accomplishing a goal on whatever budget you have, and you stick to that budget. It just has some sort of reward of that you can master something. And I think it's really hard with money. Money's hard because people want to spend it. People want stuff now. And when I say people, I say me too. I mean, if you can discipline your money, you're probably going to be very successful in life.
And I think as young people, the temptation, especially with cars, because we talked about loans with cars, seems to be a big attraction. Because I mean, let's face it, who doesn't want to drive a nice car? Who doesn't want to look, super fly, or whatever the term is, driving around, right?
On fleek.
On fleek, right? Who doesn't want to be on fleek? Who don't want to have their game up? But if you go out and once you graduate high school, graduate college, whatever the case may be, and you start driving a car, and it seems like it's way above what money you earn, it probably is. And the reason they loaned it to you is because the person that loaned it to you is planning to make a lot of money on your back. So just think about that and be smart about what you put your money to. And like Coach Castle said, you can control your money. It doesn't control you.
Well, Coach Sauer, you are the man. It is always a pleasure. I hope y'all enjoyed Monday's broadcast of Money Matters. We look forward to seeing you in the future. Coach Sauer, any parting words of wisdom?
No, sir. Appreciate being here. Thank you.
All right. Well, like we said, thank you for joining us again. We look forward to seeing you in the future. Money Matters.